Recently, there's been some new tax law changes in the IRS code, and I want to talk specifically for retirees, but anyone that's planning for retirement should be watching this video. Because what had happened is that with required minimum distributions, the IRS this year raised the required minimum distribution age to 73. But for those of you that are new, maybe you haven't heard of what is an RMD. A required minimum distribution just means that if you have not been pulling money out of your retirement accounts, let's say an IRA, once you attain age 73, whether you need the money or not, the IRS is going to force you to pull money out of your account based on your age. Each year that number keeps going up and up because they want the taxes on this money. So any money you pull out of your IRA is going to add to your income, which of course could potentially add to your marginal and push you into higher and higher tax brackets. The other thing as a retiree that we got to take into consideration is that any money that we pull out of our IRA or that we are forced to pull out of our IRA can have a direct impact on how much our Social Security is taxed as well. So there's a variety of things that are going on here with these new tax laws. So since they raised the age, there are some things that you can do to take advantage of that. If you have time on your side, one of the things that we are discussing with many of our clients is consider Roth conversions prior to required minimum distribution age. The reason why is this. If we know that right now you are in a certain tax bracket, let's just say in retirement you're in a 15% tax bracket, whatever the bracket is, and we know that no matter what, when you turn 73, Uncle Sam is going to force you to pull X amount of money out of your IRA. You're going to have to add it to your income, add it to Social Security, and now maybe that pushes you into a 20 or 25% tax bracket. Why not put yourself in a position where you can pay your taxes on that money wholesale instead of retail? Because what we do for our clients is we actually look at, hey, where's your income right now? And where's your tax bracket? So let's say, once again, you're in a 15% tax bracket, effectively, after all your deductions and everything else. Now we can actually run a mock tax return for you saying, hey, look, if we take X amount of dollars out of your IRA and put it into your Roth IRA, which accumulates tax-free, we're going to pay the tax on this money today, and we'll know how much to convert to keep you in that 15% bracket. But once that money is in your Roth IRA, obviously you already paid the tax on this money, so it's completely tax-free. But any growth, any interest, dividends, capital gains, as that money is accumulating, it's accumulating tax-free. Once you turn 73, the difference is that with the Roth IRA, you're not forced to take a distribution out. So now that money can accumulate tax-free beyond 73. The other advantage too is that whatever you don't spend, whatever's left over, if let's say, for example, you want to leave some of that money behind to your children, your heirs, we can pass that on tax-free to the children and heirs. Where your IRA, your 401k, your SEPs, your KIOs, they're going to have to pay the taxes on that money. There's a lot of intricacies with this, and also if it's designed properly, setting up the Roths, we can also set it up in such a way that we minimize the taxation on Social Security as well. Without going into a whole bunch of details and making this video, 3 hours long, if you have any questions on any of these topics that I discuss, please click the links below. We'll be happy to answer any of your questions. And if you'd like, we can give you specifics on how the Roth conversion and how the RMDs would work in your particular situation. Please like and subscribe. We'd really appreciate that. And looking forward to talking to you next time.
All for you.